A very good evening, participants. Welcome to another open house webinar on Nifty Next 50 Index Derivatives. As all of us are aware, already NSE has four indices which has derivatives, which is Nifty, Bank Nifty, Fin Nifty, and Midcap Nifty. Recently, NSE has launched futures and options contracts on fifth index, which is Nifty Next 50. So now we have five indices who have the derivatives contract on it. So with me to cover and explain on better aspects for the Nifty Next 50 derivatives, I have Rudresh Kunde from products team who will take us through the various nuances of today's session. So Rudresh, to start with, if you can please give introductory brief on Nifty Next 50 index and how constituents are aligned vis-a-vis other indices.
Yeah, thank you. So Nifty Next 50 to begin with is not a new index for NSE. It was available with NSE since 97. Earlier, it was called the Nifty Junior Index. So after the rebranding, it is now called the Nifty Next 50 Index. As you can see on the screen, Nifty Next 50 Index is part of the broad-based indices structure, which is linked to the market capitalization of stocks. So as you can see in the tree, it is a variant flowing down from the Nifty 500, Nifty 100, and then comes the Nifty Next 50. Okay, so how do we construct this index? So just to give you a brief background about it. So first, the Nifty 100 index is constructed out of the universe of 500 stocks. Okay, so the Nifty 100 index is first constructed based on the stock's full market capitalization within the top 500 index. So basically this Nifty 100, what it does is it identifies all the large cap stocks in the index. Now, once this index is constructed, this forms the universe of stocks for the next two indices, which is the Nifty 50 and the Nifty Next 50. So first, the Nifty 50 index is constructed. So how do we construct that index? So there are various parameters as part of the index methodology, such as free float, such as average impact cost, availability of stocks in the derivative segment, etc. So the first 50 stocks are selected and it forms part of the Nifty 50 index. The balance 50 stocks then form the portfolio or the index constituent of the Nifty Next 50 index. As you can see in the tree chart, you can see that the portfolio of Nifty 50 is distinct. Nifty Next 50 will be distinct. There is no overlap between the two. Also, if you see the third box, that is a Nifty Midcap 150 index. Again, that is a index of 150 constituent stocks, which comprises of the mid-capitalized stocks. And then from that, we form another index, which is called the Nifty Midcap Select. Now, all these three indices, they are basically part of the broad-based index structure, and all three indices have a distinct portfolio. So there is no overlap between the constituents of Nifty 50, Nifty Next 50, and the Nifty Midcap Select. With these three indices put together, we are altogether covering the top 125 stocks of the broad-based index structure.
Okay. And do you want to comment upon some market cap of the index constituents and what does it stand for?
Yeah. So just to give you an idea, so the full market cap of the index constituents stand around 70 trillion, which comes to roughly around 18% of the total market capitalization listed on NSE. Now, as we go on, I'll just cover with the index methodology, where you will see that we have a free float market cap, which is adjusted for weight capping. Now, this index market cap post adjustment for capping, the value comes to roughly around 22.5 trillion rupees, which is around 32% of the full market cap of the index.
Okay. And how about the index rebalancing and the free float index methodology calculation?
Yeah, so as I said earlier, the index has a long history. Over the years, the index methodology has undergone many revisions. So somewhere around 2009, May 2009, the index weighing methodology was changed from full float to free float. Okay. Later on in 2021, weight capping was introduced and the thresholds were further revised in 2023. So as we stand today, all the stocks which are not available in FNO, they are capped at 4.5% individually. and their aggregate weight is kept at 10%.
Okay.
Okay, so this rebalancing basically it is done on a quarterly basis, whereas the portfolio is rebalanced on a semi-annual basis.
Got it. Got it. Now, if we can try to understand more on the sectoral representation as well as top stocks which are forming part of this particular index.
Yeah. So as with all other broad-based indices, the financial services sector continue to be the top sector even in this particular index, but the weight of the sector is lower as compared to other indices. So here, as you can see, financial services represent almost 23.76% of the index, with top stocks being like PFC, REC, Bank of Baroda, etc. The interesting part here is the next two sectors, which is the capital goods with weight of around 11.91%, and the third sector being the consumer services sector with a similar weight of around 11.57%. Now, both these sectors together, accounting for almost 23-24% of the index, do not have any representation in the Nifty 50 index. Now, this becomes something unique for this particular index, as these two sectors does not have representation in the Nifty 50 index.
Correct.
Again, if you see, the IT sector is missing in the Nifty Next 50 index, whereas that is the second largest sector in the Nifty 50 index, where it accounts for almost 13% of the weight in the Nifty index.
Correct.
So those two are like a major differentiation in terms of portfolio of this index. So anyone who's tracking the capital goods sector or whose portfolio is more skewed towards capital goods, consumer services, they should be looking at this index for their risk management. Again, if you see on the right hand side of the screen, there are the top 10 stocks like Trent, BEL, Tata Power, etc. Interestingly, if you see almost the top 10 stocks, they are like similar weights. So everyone is like around 3 to 4% in the range, in that range.
Correct, correct. So it is almost equally distributed in terms of weights, probably one can say.
Yeah.
And at the same time, I can see that the top 10 stocks, which we have shown here, have 34.21% concentration. So if you can just elaborate, what is the case with other index derivative contracts? What is the concentration they are having in top 10 stocks?
Yeah, so interestingly to see the portfolio as on March 2024, it is not very much concentrated among the top 10 stocks. As you can see, the top 10 stocks, they account for almost 34.21% of this index. If you compare this measure with the other indices, like say the Nifty 50 or the Nifty Mid Cap, the top 10 stocks are slightly higher concentration. Like for example, in Nifty 50 index, the top 10 stocks account for almost 56%. Whereas in the Nifty Mid Cap Select, there you'll have to see that it is a 25 stock index. And here the top 10 stocks account for almost 51% of the index.
Understood. Now, another important pointer, which probably we can explain to our participant is if we have stocks with capped weightage for Nifty Next 50, and if you can also show how the weights have changed over the time.
Yeah, so as I mentioned earlier also, so Nifty Next 50 index, it uses the periodic capped free float methodology. Here, the index constituent stocks, which are already available in derivatives, they will have an aggregate weight of around 90% or more always. All stocks which are not available in derivatives, they are currently individually kept at 4.5%, and their aggregate weight is kept around 10%. Okay. So just to give you some history, so the weights that it will keep on changing on a daily basis because of price movement. Okay, so as you can see on the screen, so for example, Zomato, the weights have changed from 1.7% end of December 23 to almost 1.72 end of March. So it is because of price changes. Now, again, the capping factor of stocks is realigned upon replacement of scripts in the index and on a quarterly basis on the last trading day of March, June, September, and December. Okay, here we consider the closing prices on a T-3 basis. Okay, where T day is actually the last trading day of the month.
Correct.
Okay, the weight of cap stocks is likely to change higher. Now here what we see is first what we see is because of the price changes. The other change what we see here is because the it is likely to change when constituent stock itself are included in derivatives or during the semi-annual review there is a rebalancing happening of portfolio and the incoming or the outgoing stocks availability in derivatives play a major role in determining the weight of these particular stocks. As you can see on the screen, like last 4 quarters, the aggregate weight is roughly almost near to 10%. Okay. And within that, the weights keep on changing. Like for example, Zomato, it was like in June 23, it was 1.13, but over the year, it has gone to 1.72.
Correct.
Okay. But the aggregate weight of all the stocks which are not available in FNO, they are kept at 10%.
Okay, understood. Another probable factor which participants might be interested to know is these constituent stocks of Nifty Next 50. How is the respective volumes in cash, equity futures, and equity option segment? If you can just give idea on that particular part.
Yeah. So the underlying constituent 50 stocks are very liquid. In terms of turnover, the all 50 stocks put together, they will account for almost like 16,000, 15,950 crores of the capital market turnover. And they account for almost 16.3% of the CM turnover in March. Okay. During the same period, if you see the constituent stocks futures turnover, they account for almost like 30,000 crores, 29,626 to be precise, and they account for 21% of the stock futures turnover. In terms of stock options, you can see that these stocks, they aggregate premium turnover is about 1,571 crores daily average. Okay, in March, which almost contributes to 24% of our total stock options premium turnover.
Okay. And are there any other factors through which this particular liquidity profile can be observed by participants?
Yeah, so there are certain other parameters through which we can see the liquidity or we measure the liquidity. Like for example, the impact cost, delivery turnover, or the median quarter sigma, which we consider for determining the eligibility of stocks in derivatives. So all these also are considerably very liquid, and you can see this some of these measures, they are available freely on our website also. So you can check their history also. So all this data is available on the NSE website.
Thanks, Rudresh, for explaining this important facet. Now, if we can discuss comparative returns which are witnessed for Nifty Next 50 index vis-a-vis the peer indices, which will give more clearer idea to the participants.
Yeah, so you might have read it in news as well. So this index particularly has been outperforming in last 1 year. So it has almost given 61% in last 1 year. But nevertheless, so what we have seen of late is the small cap, mid cap, they have been outperforming. They have been giving good returns. And similarly, if you compare Nifty Next 50 with its larger counterpart, which is Nifty 50, Nifty Next 50 tend to have given a higher return. So if you see the 3-year CAGR, the total returns of this index in last 3 years, it stands around 22%. If you compare the same with Nifty 50, it stood at 16%. So you can see that Nifty Next 50 has delivered higher returns compared to Nifty 50. Similar is the case for the 5-year period, where Nifty Next 50 has delivered almost 17.5% return as compared to 15% by Nifty 50. Now, if you compare this with the mid cap or the small cap, this index has given slightly lower returns as compared to mid cap and small cap indices. In terms of dividend yield also, the dividend yield of Nifty Next 50 is comparable with Nifty 50. So right now in March 24, the dividend yield stood at 1.3%, whereas the dividend yield of Nifty 50 was 1.2%. In terms of dividend yield, it is slightly higher as compared to the mid cap stocks or the small cap stocks. As you can also see that Nifty Next 50, the performance is good. It's available for last so many years, and there are a lot of financial products already available on this particular index. As you can see on the screen, so there are almost 7 ETFs which are already existing on this particular index for many years. The AUM is almost 9,200 crores. There are 13 index funds which are benchmarked to this particular index, and the AUM of this is about 10,000 crores. So in all, we have almost 20,000 crores benchmarked to this particular index.
Okay, great. And apart from this index performances, how is the annualized volatility and correlation comparison with other indices? And if you also may tell what does it mean for the participants as well who are going to trade this contract?
Yeah. Earlier also what I mentioned is, so this particular portfolio is unique. It is unique because there is no overlap of the constituent stocks with Nifty 50, neither with the mid cap indices. Okay. So here what we can see is the Nifty Next 50 has a higher correlation, has a correlation of about 71% with Nifty 50, but a higher correlation with the mid cap indices. So almost 81% is the correlation with the mid cap index
In 1 year period, right?
in one year period. If you see it for 3 years period also, the mid cap Nifty is having a higher correlation of almost 87%.
Okay.
Okay. Okay. In terms of beta also, the beta is almost 0.95 with the Nifty 50 index. Okay. The index volatility of Nifty Next 50 is almost comparable with that of mid cap, and it is higher as compared to Nifty. So as you can see in last 1 year, the Nifty Next 50 volatility, annualized volatility stood around 13.2%. In contrast, the Nifty 50 index volatility was marginally lower than 10%. During the same period, you can see that mid-cap Nifty volatility is almost 13.2, which is comparable with Next 50.
Correct.
So with this, you can like see that the behavior of Nifty Next 50, though it has a portfolio of all the large cap stocks, it is more towards the mid-cap Nifty. The performance is more tuned towards the mid-cap Nifty. So it has a higher volatility, higher correlation with mid-cap Nifty. So it is a unique index wherein it has a large cap portfolio, more what I would say is more inclined towards the mid cap Nifty side.
Correct. And probably another important facet that people can understand over here is in 1 year, next 50 volatility is somewhere around mid cap Nifty and slightly higher than Bank Nifty Fin Nifty. But if we go towards 3 years period, then probably with all three indices comparison, it is relatively lower for Nifty Next 50.
Right. So mid cap has been rallying for last 1 year to 3 years period. That has been more volatile, of course. So as you can see in the 3 years period, the mid cap Nifty volatility has been 18% and upwards.
Correct.
As compared to the sectoral indices, which is the Bank Nifty and Fin Nifty, the volatility this year has been higher in the Nifty Next 50. But as you can see on the screen, it has been lower when compared to the 3 year period.
Correct. Correct.
One of the reason for this can be is Nifty Next 50 has a financial services sector weightage lower as compared to in say Nifty or any other index.
Okay, thanks. Now, if you can just share what are the important trading related facets which participants have to keep in mind while trading this contract?
Yeah, so to begin with, first of all is a symbol. So it's a Nifty Next 50. So one of the most important thing here is the trading cycle. So to begin with, we have launched the monthly futures and the monthly options with the expiry day as the last Friday of the expiry month. So when the contract is getting generated, if the last Friday is a trading holiday declared at the time of contract generation, the expiry day will be the previous day. As you can see, the lot size is quite low. So at the time of introduction, it was somewhere around 6.2 lakhs.
Correct.
Okay. I'm assuming that the index value is around 62 to 63,000 in that range. And the contract value would hover around 6.2, 6.3 lakhs. Okay. As with all other indices, the option type is European call and the European put options. Here, one interesting thing is the strike scheme. So at the time of introduction only, we have introduced something called a staggered strike scheme interval, wherein we have introduced two strike intervals. One is of 100 and the other is of 500. So with the 100 strike interval, we are having a 40 strikes on the either side of ATM. And in the 500 strike also, we are having 20 strikes on either side of the ATM.
Okay, understood. It may be possible that this two strike interval scheme may be a little confusing to people. So if you can explain it more with some illustrations or example.
Yeah. So first of all, why we introduce this? So what we used to see is, suppose if we had to introduce only the 100 strike interval. Now to give you a wider coverage for participants, like say almost 15%, we would have to introduce double the number of strikes. Now what happens is, as you go away from the ATM, there are few strikes which become illiquid. Now to reduce those things, we have introduced this staggered strikes, wherein near the ATM you would have finer strike intervals, and when you go away from the ATM you would have wider range strike intervals. So for this index, what we have chosen is strike interval of 100 near the ATM, and as you go away, we have introduced the 500 strike intervals. Now with this, what has happened is, suppose if we assume an index value of 62,000, the narrow range, that is the 100 strike interval, will give you a coverage of 6.5% on either side of the ATM, whereas the wide range, that is the 500 strike interval, they will give you a coverage of almost 16% on the either side of ATM. Now here, one important aspect to know is, when we are introducing the 500 strike interval, we are including the uh, we are including that 500 strike which is generated for out of that 100 strike interval as well. So basically the option chain will be uniqued out.
Okay.
Okay. When I say 500 strike interval with 2120, that doesn't mean this 20 will start after the 100 strike interval is ended. Okay. There is an overlap between the two. So as you can see on the screen, from 62,000 onwards till 66,000, you have this 100 strike interval on a continuous basis. After 66,000, you see that only the intervals of 500 are available. So from 66,000, it moved to 66,500, 67,000, and so on. So beyond the 40th strike interval of 100, you see that the strike intervals are only of 500, multiples of 500. Okay. So basically the additional strike starts from the 9th strike. Okay, the first 8 strikes, there is an overlap.
Correct.
Right? It has an overlap with the 100 strike interval. So this way, what has happened is, we have just increased the coverage, at the same time trying to aggregate all the orders in a particular strike. Otherwise, what would have happened is, like from 66,000 to 66,500, there will be 4 more additional strikes. Now, as you go away from the ATM, there is less chance of liquidity there is a higher chance of liquidity getting fragmented because of more number of strikes. Okay. So here what we have done is, we have reduced the number of strikes. At the same time, we have ensured that the participant gets the required coverage. So in case there is a higher movement on any one side of the index, still there is a lot of range available to market participants.
Right. Okay. We have just explained that it's a monthly futures and options contract, right? So if you can just tell participants how many contracts will be parallelly available for trading. Second part of the question is, which is the first expiry which is coming in, because the trading has started just recently on 24th of April. So which will be the first expiry that will be kicking in? And also if you can mention if there are any transaction charges applicable for Nifty Next 50 derivatives contract.
Yeah, so as I told earlier, so we have only introduced the monthly futures and the monthly option contract. Okay, so here we have launched 3 serial monthly contracts. So the near month, middle month, and the far month. Okay, when we launched this product, we launched it on 24th, but we have not introduced the April expiry because it was just 2 days away.
Correct.
So we first began with the May expiry. So here, May 31st, 2024 expiry is the near month expiry. The June expiry is the middle month, and July expiry is the far month expiry.
Okay.
Okay, since the launch, so it has been a very tremendous response what we have got from market participants. We have observed that almost 475 trading members have already participated since launch. We have already issued a circular in this regard that exchange transaction charges have been waived off. So any new product which is coming to market, so the first 6 months is generally there is an exchange transaction charges waiver. Okay, so right now the waiver is up to October 2024. I was again explaining about the strike scheme. So one more point to note here is, there are reserve strikes which are available here. So in case there is any adverse movement, say the index goes up by 12%, 15%, so the reserve strikes will be enabled during the day. Okay, so at any given point in time, you will have strikes available for trading.
Okay.
Okay, another advantage what we had when we launched this index is, since I told that this index was available for a very long time. So this index, the index values, they are easily available on Bloomberg or Refinitiv or all the data aggregator providers.
Correct.
So here you can see I put some of the ticker codes for Bloomberg and Refinitiv.
Correct. So I guess that was very apt explanation on some key nuances. So I guess this was the part that we wanted to explain. But with this, Rudresh, if you can lastly summarize on important aspects through which this contract can be beneficial for trading to the market participants? If you can summarize on certain pointers.
Yeah. So first, the most important key point is you are not trading the same index.
Correct.
You are trading a index which is distinct. The portfolio is distinct. So it has no overlap with Nifty 50. It has no overlap with the mid cap index. So it's a third index which is purely distinct. So that's the first advantage. The second advantage is since the portfolio is completely different, the sectoral representation has been completely different. As you can see, the concentration of financial services is on the lower side as compared to Nifty 50 index. Again, you get a representation from newer sectors like capital goods, consumer services, etc.
Correct.
Information technology, which is the second highest sector in Nifty 50, does not have any representation here in this particular index. So that is another differentiation. To begin with, we have started this index with monthly futures and monthly options. To notice here, the expiry day is on Friday. Okay, so the last Friday of the month, that's the expiry day. In terms of correlation, you may note that this index has a higher correlation with the mid cap and the small cap stock portfolios. The lot size is on the lower side. So as you know that SEBI has prescribed certain norms for contract sizes. So it has to range between 5 lakh and 10 lakh. So at the time of introduction, so assuming the index value is in the range of 62,000 or 63,000, the contract value will be somewhere around 6.2, 6.3 lakhs. So that's another advantage. It is not a very high value contract right now.
Great, great. So I guess this was sufficient explanation that we wanted to give as of now for the new contract that we have launched in terms of Nifty Next 50 index derivatives. Still, market participants, members, and other traders, if you are having any queries or questions, you may please reach out to your respective RMs at regional offices, or you can also email to head offices' respective department, and we'll be glad to provide you responses and we'll be happy to reach out to you. Now, with this, today's open house webinar, we are going to conclude. As all of you are aware, we'll keep doing more and more such open house webinars in coming time. We'll keep you informed on such sessions. You can also suggest on various topics if you want to. With this, thank you. Thank you for joining in today. Have a nice day ahead. Thank you very much. And thank you, Rudresh.
Thank you.